Okay, let's unpack this. The stock of Zoomcar, ticker ZCR, saw some really wild pre-market action on May 1st, 2025.
Yeah, I saw that. Shot up pretty high, didn't it?
It did, around 8.90. But here's the kicker. The day before, April 30th, it closed at $4.07. Much calmer.
Wow, that's quite a jump. Really highlights the volatility, doesn't it? Hints at, well, speculation, maybe.
Exactly. And that's what we're diving deep into today. We've got this comprehensive research analysis dated May 1st, 2025, called the ZCCR Deep Value Analysis.
Right, looking at Zoomcar Holdings, they're in that peer-to-peer car sharing space, mostly in India now.
Yep. And our mission today, basically pull out the most critical stuff from this report and other sources we've looked at: business management, financials, market position, future prospects, the whole shebang.
Think of it as a shortcut for you, the listener, to get a handle on this pretty complex situation.
We're trying to understand the real value here and maybe more importantly, the risks. Kind of like a value investing approach, a bit Warren Buffett-esque.
To see if there's something hidden or if the market's right to be skeptical.
And just so you know, this isn't just pulled out of thin air. We're leaning heavily on that ZCAR Deep Value Analysis report.
Which itself uses SEC filings, 10Ks, 10Qs, 8Ks, S1s, DF 14As, all that jazz.
Plus press releases, news articles, financial data, everything available as of May 1st, 2025.
It's important to have that wide range of sources. Helps paint a fuller picture.
Okay, so roadmap time, first half. We'll get into the business itself, check out the management, and dig into the financials.
Then later, we'll tackle market sentiment, who owns the stock, the risks including a SWOT analysis, and wrap it all up.
And we'll leave you with a, let's say, interesting question to chew on. So buckle up. Let's start with Chapter 1, Business Understanding. What's Zoomcar actually do?
Right. So their business model has, well, it's changed. They used to own cars, that asset-heavy model.
Like a traditional rental company.
Sort of, yeah.
Yeah.
But the report suggests that really strained their finances. So they shifted.
Shifted to what?
To an asset-light, peer-to-peer marketplace, P2P. Think Airbnb, but for cars.
Okay. So people list their own cars.
Exactly. And they're now focused almost entirely on India. They pulled out of Indonesia, Egypt, Vietnam.
And this shift, was it strategic or?
Seems like it was driven more by financial distress, honestly. A necessity.
Gotcha. So how do they make money now? Fees?
Primarily, yeah. Fees on the platform. Likely commissions from the rentals between the hosts, the car owners, and the guests, the renters. Maybe fees on both sides. And interestingly, they've tried other things to get cash up front. Vehicle subscriptions, prepaid Zoomcar vouchers.
Ah, trying to boost liquidity. Makes sense given the distress signal.
Precisely. Plus, the usual late fees, damage penalties, that kind of thing.
And revenue, how's that looking?
Well, trailing 12 months revenue as of December 31, 2024 was $9.12 million. The last quarter of that year was $2.45 million.
Which is good. Bad.
It's basically flat. Negligible growth year over year. That's not great when you've just changed your model.
No, that sounds pretty stagnant. What about the platform itself? What does it offer?
It's pretty standard P2P stuff.
Yeah.
App and website, search for cars by location, type, dates. Handles booking, payments.
Communication between users.
Yep. Built-in communication. A cool feature is keyless entry using IoT devices in the cars.
Oh, that's handy. No key handover needed.
Right. Plus vehicle tracking, rating systems for both sides, flexible rentals, 2 hourly, daily, even monthly.
Anything else?
They've also mentioned Zoomcar cabs, rentals with drivers, which is interesting, maybe hedging their bets, and Zoomcar assured fulfillment centers.
Fulfillment centers? For what?
Seems like they help hosts with things like cleaning, maybe key management if they don't want to be hands-on.
Okay. Now, you mentioned their claims about scale.
Ah, yes. They say they're India's largest P2P car-sharing marketplace. Operating in loads of cities, numbers like 34 plus up to 99 plus get thrown around.
And vehicles. Users.
Over 25,000 registered vehicles claimed. Millions of users, 10 million plus app downloads, maybe 2.4 to 5 million actual guest users. Big numbers.
But I sense a but coming.
But their market cap in late April 2025 was below $3 million USD.
$3 million. With that kind of claimed scale?
That's
tiny.
Exactly. It's a massive disconnect. Suggests the market is deeply, deeply skeptical about those claims or their financial viability. Probably both.
Yeah, that's a huge red flag right there. So what's the value proposition they're pitching?
For guests, access to cars. Maybe cheaper than owning, convenience, flexibility, unlimited kilometers, no security deposits sometimes. They even push a sustainability angle.
And for the hosts? the car owners.
It's about making money from an idle asset, offsetting car ownership costs. Micro-entrepreneurship, they call it. Zoomcar offers tools like AI pricing, those optional fulfillment services too.
Makes sense on paper, access for renters, income for owners.
Right. But execution is everything.
Yeah.
Now let's look at the wider industry in India.
Okay, the market context.
Big trends driving shared mobility. Urbanization, city living makes car ownership less appealing. Rising incomes, historically anyway. Changing preferences, especially younger people wanting access over ownership.
Tourism, business travel too, I guess.
Definitely. Plus, technology adoption smartphones are everywhere. And maybe EVs down the road.
So the market's growing.
Projected to grow quite a bit, yeah. KGIs mentioned are anywhere from like 8% and nearly 14%. Could be a $3–4 billion market by 2027 or so. Global PDP is also growing fast.
So there's definitely opportunity in the space.
There is. But
yeah,
the competition is fierce.
who are they up against?
Other PDP self-drive platforms like Rev, DriveZ, MyToys, Miles. Interestingly, some of those have also struggled financially. Tells you it's a tough market.
It's not just the direct competitors, though, is it?
Nope. You've got the ride-hailing giants, Ola and Uber, getting into rentals, and the traditional players like Avis, plus local operators.
So that claim of 95% P2P market share
Seems highly optimistic, let's say.
Yeah.
Very questionable.
Okay, now for maybe the elephant in the room, the regulatory side.
Ah, yes. This looks like a critical challenge, especially for their P2P model in India.
Why is that?
The Motor Vehicles Act of 1988. Basically, it prohibits using private vehicles' white license plates for commercial use, like rentals, unless you have commercial permits and yellow plates.
But Zoomcar's model relies on people listing their private cars.
Exactly. So the core model seems to operate in a legal gray area, potentially impacting their supply of cars.
And insurance.
That's another big one. Standard private car insurance typically doesn't cover commercial use. Huge risk if there's an accident.
Is there specific regulation for PDP car sharing?
Doesn't seem like it. Not like ride-hailing, which has seen some specific rules. Plus, rules can vary state by state in India. It's messy.
More headaches.
And on top of all that, they're currently not compliant with NASDAQ listing rules, and they have ongoing tax disputes, so regulatory and legal challenges galore.
Oh, wow. That sounds like a fundamental threat to the whole business model.
It really does. So if you wanted to compete, what barriers would you face?
Good question. What does the report say?
Significant barriers. Network effects are key. You need lots of hosts and guests. Building the tech platform, booking, payments, IoT, tracking costs money and time.
Navigating that regulatory mess we just talked about.
Absolutely. Building trust and safety is crucial, but hard in PDP. Brand building in a crowded market. And you still need capital, even if it's asset light.
Okay, so it's not easy to just jump in. What about Zoomcar's economic moat? Any competitive advantages?
Well, they have some brand awareness, being an early player, but lots of negative customer feedback seems to undermine that.
Cost advantages from being asset light.
Theoretically, yes, but their high operating costs and debt mean they haven't really seen those benefits on the bottom line. Network effects seem weak due to churn and the regulatory issues.
Switching costs. Easy for users to go elsewhere.
Seems pretty low for both guests and hosts. They have tech, experience, partnerships, but is it truly differentiating? The report is skeptical. Even questions Morningstar's narrow moat rating is maybe too optimistic.
Okay, so a shaky moat at best. That covers the business landscape. Let's move to Chapter 2. Management. Who's running the show?
Right. Leadership is key, especially in a turnaround situation, or, well, survival situation.
So the CEO?
Hiroshi Nishijima took over as interim CEO in June 2024, confirmed later. Background at Honda, but also mobility tech like Grab and Via in Japan. Consulting experience too.
What's his focus been?
Stabilization. Trying to improve the customer and host experience in India, cutting costs, managing cash, growing the car supply. His salary was cut, and he did buy some stock personally, late 24, early 25.
Okay. Insider buying can be a positive signal, though context matters.
Who else? Uri Levine. He came back as chairman in March 2025. Big-name co-founder of Waze and Move It.
Wow, that's significant experience.
It is. He was actually chairman before 2021-2023. His return is framed as bringing expertise for growth and operational excellence.
But his previous stint coincided with the lead-up to the current problems.
That's the wrinkle, yes. So big name, but can he engineer a turnaround now? PBD.
And the CFO?
Achin Gupta. Promoted in April 2024 from financial controller, where he'd been since 2019. So he knows the history. Tasked with managing finances through this crisis, liquidity, debt, reporting amidst defaults, ex-Amazon.
Tough job. What about past leadership?
Greg Moran, the co-founder and longtime CEO, was terminated in June 2024. This followed SEC inquiries about missed revenue projections during their SPAC deal.
Ah, that doesn't sound good.
No. And Adarsh Menon, appointed president in Jan 2024, resigned just 6 months later. Lots of churn at the top.
High turnover, like that definitely shakes confidence. How has this current team responded to the crisis?
A flurry of activity. Multiple highly dilutive private placements, basically selling stock cheap to get cash. Major cost cuts. Trying to negotiate with debt holders, settling some, but still facing lawsuits.
It's like the ACM Zoomcar convert one, seeking around $5.6 million.
That's one, yeah. They've refocused on India, exited other markets, tried to get back in line with NASDAQ rules via a reverse stock split.
But despite all that,
the going concern warnings persist in their filings. Big red flag from auditors saying there's substantial doubt the company can stay afloat.
right, that's serious. How's their communication? Transparency.
They do the standard stuff,
Yeah.
SEC filings, press releases, investor relations website, some earnings calls. But there seems to be a disconnect. Lots of customer complaints about poor service, refunds, questions about transparency with hosts on revenue sharing. The official story doesn't always match the user experience, it seems.
Okay. And ethical reputation. Any issues there?
Quite a few highlighted in the report. Those customer service failures, the regulatory and legal mess, we talked about PDP legality, past data breach, a banned ad, debt defaults, lawsuits, tax disputes.
Long list.
And crucially, there's an investigation by a law firm, Morris Kandanov LLP, looking into potential breaches of fiduciary duty during insolvency. Basically, did management act properly toward creditors when the company was broke?
Wow, that's a major issue. Plus the founder CEO's termination circumstances.
Exactly. It all adds up.
So if we assess them on honesty, capability, shareholder orientation, where do we land?
It's not looking good, based on a report as of May 1st, 2025. While Nishijima and Levine have experience, the challenges are immense.
And the history, the investigations.
They raise serious questions about past conduct and transparency, and the shareholder value destruction has been catastrophic.
So while the current team is trying to survive, actions like those dilutive fundraisers hurt existing shareholders badly.
Right. It's hard to give them a passing grade on being demonstrably honest, fully capable of a turnaround, and properly shareholder-oriented right now.
A sobering conclusion on management. Okay, let's pivot. Chapter 3. Financial health. Time for the numbers.
Yeah, this is where the rubber meets the road, or maybe where the wheels fall off.
Let's see. Key metrics first. What does the report show as of early May 2025?
Market cap.
Yeah.
Tiny, around $2.89 million, and very volatile. PE ratio, negative or NA, they lose money.
We saw the TTM revenue was $9.12, basically flat growth. Margins.
Gross margin around 33%, not terrible in itself, but
Doesn't cover operating costs.
not even close. Operating margin,
Yeah.
massively negative, like negative 132% to negative 280%. Net margin, also deeply negative, negative 233% to negative 346%.
Ouch. Debt to equity.
Negative or NA, because equity is negative. Total debt around $15.17 max-ups against negative equity of about negative $38.04.
Negative equity, that's bad. Free cash flow.
Burning cash significantly.
Yeah.
Negative $18.78 million TTM. They were like constantly on outside funding.
Which gets harder and more expensive with financials like these. Price to sales, price to book.
PS is super low, 0.14x to 0.3x typical distress signal. PB is negative because book value is negative.
Okay, the metrics paint a grim picture. What about overall financial stability?
Earnings consistency? None. Just a history of big losses year after year. FY21, FY22, FY23, TTM to 24, all red ink.
Dividends.
No dividends, no chance of them anytime soon.
Debt management.
It's been poor, high debt, multiple defaults, creditor actions like Avon's repossessing vehicles, that ACM lawsuit, forced restructuring, terrible interest coverage.
And working capital.
Yeah.
Ability to pay short-term bills.
Severely negative working capital. Current liabilities, $46.77. Dwarf current assets, $6.02 as of days 24. Current ratio around 0.13, quick ratio even lower. Acute inability to meet short-term obligations.
So financially, they're on very shaky ground.
Extremely precarious. That going concern warning seems entirely justified by these numbers.
Okay, that wraps up the first half. We've seen the business model challenges, regulatory hurdles, leadership questions, and now the dire financial state. Let's move to the second half, starting with Chapter 4, market sentiment. How does the market feel about ZCAR?
Well, based on everything we've discussed, you can probably guess it's overwhelmingly negative.
How do we see that?
The stock price crash is the most obvious sign, down over 99% since the SPAC deal. It's a microcap stock, which often means higher risk.
And the volatility we mentioned at the start.
Exactly. Huge swings. The reported beta is low, which seems odd, but the price action tells the real story. Plus, the NASDAQ non-compliance and potential delisting risk.
That hangs over them. News flow mainly negative.
Predominantly, yeah. Financial distress, defaults, dilution. Occasional positive news might cause a temporary spike, but the underlying trend is down.
Analyst coverage. Price targets.
Pretty much non-existent, typical for distressed microcaps. Analysts tend to drop coverage.
So recent news hasn't helped much. Even Levine's return.
Levine's return caused a brief flicker of retail interest, but it didn't last. The financial reality just overshadows everything else. Even the reverse split aimed at compliance is often viewed negatively.
What about short sellers? Are people betting against the stock?
Oh yeah. Short interest is high, reported around 19%, and the cost to borrow shares to short them, astronomical. Over 700% annualized recently.
Wow. That shows strong bearish conviction, but also makes shorting expensive and risky.
Exactly. High off-exchange short volume too, and lots of fails to deliver around the reverse split. Options trading seems very limited or non-existent.
So, strong bearish sentiment, high cost to bet against it. Okay, Chapter 5. Ownership structure. Who actually owns ZCAR?
This is interesting too. Institutional ownership. The big funds, pension plans, etc., is exceptionally low.
How low?
Generally reported below 4%, maybe even lower depending on the source. And the few names mentioned, like HRT, Virtu, Citadel, are often market makers holding small positions, not long-term believers. Very few institutions involved overall.
That lack of institutional confidence speaks volumes, doesn't it?
It really does. Sophisticated investors seem to be staying away.
What about insiders? Management and board?
Also relatively low holdings, maybe 2% to 6%.
Yeah.
We noted CEO Nishijima bought some shares. A director bought some, then resigned. Not exactly a massive vote of confidence from insiders overall.
So who owns most of it?
It's highly fragmented. Around 94–95% held by the public or other. There was one fund, L1 Capital, that took a passive stake of nearly 10% in late 2024, likely tied to a financing deal. But mostly it's dispersed.
How does this ownership structure impact governance?
Well, the board's actions, firing the CEO, bringing Levine back, the dilutive deals, reverse split, show they're reacting to the crisis. But it raises questions about oversight before the crisis hit.
And the NASDAQ non-compliance is a governance failure, too.
Right. And that insolvency investigation is a major red flag hanging over them. With so few large institutional owners, there's less external pressure on the board for better governance. It looks challenging.
Okay, let's put it all together in Chapter 6. Risk assessment, using a SWOT analysis. Strengths first.
Strengths. Brand awareness in India, they have the P2P tech platform, the asset-light model potential, experienced leadership now, and that focus on the big Indian market.
But those strengths seem heavily caveated by everything else we've discussed. Weaknesses.
Weaknesses. The list is long. Extreme financial distress losses, negative equity, debt, defaults, concern risk, poor customer reputation, operational issues, massive regulatory uncertainty, NASDAQ noncompliance, delisting risk, management instability, failed international expansion.
That's a lot of weakness. Opportunities. Any light at the end of the tunnel?
Opportunities. The sheer size of the Indian market is one. If regulations did become more favorable for P2P, that would help. Improving customer experience is an opportunity. Using tech like AI. Maybe EV integration eventually.
But seizing those opportunities seems tough, given the weaknesses. Threats.
Threats are significant. Bankruptcy insolvency is the big one. NASDAQ delisting. A regulatory crackdown could kill the P2P model. Intense competition. Simply running out of money. Unable to secure funding. Creditors taking action. Reputational damage getting worse. A weak economy hitting consumer spending.
A minefield of threats. The report also looked at hypothetical U.S. tariffs. Did that matter?
Not really. According to Zoomcar and the analysis, their business is almost entirely within India revenue, cars, operations, so direct U.S. tariffs wouldn't hit them much. Maybe tiny indirect effects on tech costs or the Indian economy, but their internal problems are vastly bigger threats.
Okay, makes sense. That brings us to Chapter 7, conclusion. Let's synthesize.
So, summing it up, Zoomcar is in a dire financial state, facing huge operational hurdles, critical regulatory risks, and the market sentiment is just terrible.
And from that value investing perspective we talked about.
It fails pretty much every test. Understandable business? Not really, given the regulatory fog and unclear path to profit. Favorable long-term prospects? Hard to see with the financial distress and risks. Able and trustworthy management. History and investigations raise major doubts. Attractive price. Looks more like a value trap with a high risk of losing everything.
So the bottom line is?
ZCAR looks like an extremely high-risk investment as of May 2025. High probability of capital loss, does not meet prudent value investing standards. Full stop.
Okay, so as we wrap this deep dive, here's that final thought we promised for you to consider. Given those deep regulatory uncertainties around P2P car sharing in India, are Zoomcar's efforts to pivot and survive ultimately just fighting a losing battle against the legal framework, no matter what they do operationally or who's leading them?
It really questions if the model itself is viable there, doesn't it? A tough question.
Indeed. Well, thank you for taking this deep dive with us into Zoomcar. It's clear that despite their market presence, the risks and challenges are just immense.
Yeah, understanding these issues is vital if you're looking at this company. All the sources we used are in the description, by the way.
And if you found this analysis useful, please do subscribe to the Stock Analytics AI YouTube channel. We do more deep dives like this.
And the usual reminder. This was for research and informational purposes only. It's not financial advice. Investing always involves risk. And remember, AI analysis has its limits. Always do your own research.
Thanks for listening.